Okay, so in this lesson, we are going to answer that million-dollar question. Should you convert your IRA or your qualified plans to a Roth IRA? Well, maybe it's not a million-dollar question, but it definitely has a financial impact, and you need to maybe know the answer before you make this decision. Maybe you do feel like taxes are going to go up in the future and that concerns you. Maybe you want to retire without having to stress out about taxes going up while you're in retirement. Imagine being 80 years old and having taxes go up. Your income is going to go down because your money that's coming out of a qualified plan is being taxed on a regular basis as ordinary income. So lots of things to consider, and maybe you've decided that you want to convert your IRAs to a Roth IRA. Well, if that's the case, there are a couple things to consider. The first question you have to ask yourself is, do you think taxes are going to go up in the future? Are you on that path to be able to retire at the same level of income as when you're in those latter working years? And is your income tax bracket going to potentially be higher in retirement? If that's the case, maybe you do want to pay your taxes now and get them out of the way. But if you do a Roth conversion, you can't take the money out of your IRA to pay the taxes because remember, unless you're 59 and a half, you don't have access to that money without that penalty and paying all the taxes and everything. So if you do a Roth conversion, you don't have to have a penalty of 10%, but you do have to pay the taxes. So if you have $100,000 and you're in a 20% tax bracket, you have to come up with $20,000 to pay your taxes to do that conversion. So you can convert from an IRA to a Roth IRA without a penalty, but you do have to pay the taxes, and those taxes have to come out of your pocket. So remember, opportunity cost is the theme of this whole module and this whole course, really. So you have to ask yourself, what is the opportunity cost of coming up with $20,000 and paying that to the IRS this year? What could that money have earned between now and when I retire? All right, now, of course, your situation could be different, so you want to look at this with your specific numbers. But in this example, let's take a look at a few numbers here of a 40-year-old that wants to retire when they're 65. So we've got 25 years of accumulation. And then let's just say this client is going to die at 85. Could be 95. The longer you live, the more potential income you could get from a tax-free income basis. So, the amount of, time in retirement is also going to have a big impact on these numbers. And let's just say we're looking at a nice even $100,000 and a 5% rate of return, both in those accumulation years as well as in the distribution years. Let's just keep it simple and say the rate of return on all this money is the same, because we just want to really analyze the tax implications of this. So from a tax standpoint, let's say that you are currently in a 20% tax bracket, but let's say that you're afraid you might be in a 30% tax bracket or higher when you retire, right? So if you think that your income is going to go up from 20% to 30%, that's obviously going to be a big factor in this decision, right? So remember, if you're at $100,000 in an IRA, at a 20% tax bracket, you're going to have to come up with $20,000 to pay in taxes. So the question is, what could that $20,000 have earned if you didn't pay the taxes on it? So let's take a look. All right, so first of all, we are going to look at the income, and then next we'll look at the account balance. But let's look at the income from age 65 through age 85. So those 20 years during retirement, what would the income look like? Well, first of all, we have after-tax income from a traditional IRA, right, of $369,000 after you've paid your taxes at a 30% tax bracket, because remember, they went up, right? But remember, we have this conversion tax account. This is that $20,000 that we could have invested. So let's assume that we took that $20,000 and invested it instead of converting to a Roth IRA. So we keep our IRA, We take the $20,000 and we invest it. Maybe we invest it tax-free. In this example, we're assuming we're going to invest it somewhere tax-free because maybe you've learned by now where you can invest your money tax-free instead of putting it into a qualified plan. Well, the after-tax income on that $20,000 during that retirement year, during those retirement years, is $73,000. So if we add these two together, we're going to get $443,000 of income during retirement. Now, if you live a longer period of time in retirement, then that number, of course, is going to change. Now, if we did the Roth IRA, okay, and we have, in this case, a total income from that Roth IRA of $528,000. And it's all, of course, income tax free. So income tax free, this was after taxes, right? So my net, or the difference, is going to be $84,000. So if you have the $20,000 available that you could give to the government this year to do that Roth IRA conversion, it could benefit you if you lived 20 years in retirement and if your numbers were similar to this. Of course, your numbers may be completely different, right? Now let's look at the account values. So if we, keep our IRA money, it is going to go from, it's going to grow from $100,000 to $338,000 in my traditional IRA, assuming I didn't do a Roth conversion, okay? My estimated taxes due, which is going to be based on that assumption that we're looking at a 30% future income tax bracket, is going to be $101,000 that we've got to come up with. So at retirement age, okay, at retirement age of age 65 for this 40-year-old, my IRA after-tax value is $237,000. Now, what about this conversion account? Okay, this is that account that I took, the $20,000 and I invested it tax-free. Okay, it grew to $53,000. Estimated taxes due, 0, because I put it into an account that grew tax-free, right? So, conversion account after tax value, $53,000 because there's no taxes there. My total traditional IRA plus my conversion account is going to be $290,000, which is this number plus this number, okay? We're adding those two numbers together to get to my $290,000 that I have between those two accounts. But if I took the $100,000 and put it into a Roth IRA and paid the taxes out of my pocket, my Roth IRA would grow to $338,000. It's obviously better in this case, right? Better by $48,000 from an account balance standpoint at retirement age, okay? So in both of those examples that we just looked at, you're better off to do a Roth conversion, but remember, you have to come up with the money to pay the taxes that year. So those are some things to consider. So you have to think about what is the rate of return that you could be getting, what's your opportunity cost, right? You have to think about the longevity of how long you plan on living in retirement. You have to think about whether or not your taxes are going to be higher or lower in retirement. Lots of things to consider. So hopefully this is helpful. Once again, as always, if you want to run your own specific numbers, there's a link to our calendar in the membership area. Book an appointment with us. We'd love to talk with you to see if this makes sense for you.